Hey everyone, how's it going? It's Russell here, and a recent change to interest rates by the Bank of Canada has led to 35% of Canadians saying that this change could push them towards bankruptcy. And coming out of the pandemic with the horrible crisis that's going on in Ukraine right now, more changes could be coming at you more quickly. And these changes could affect you, with the government not able to provide funding for many of the benefit programs and plans that they previously had in mind, not to mention what could happen to your investments down the road. So in today's video, we'll be going over exactly what this change is and why they're even doing it in the first place, along with what it means for you, these government programs, your money, and your investments. But before we do, make sure to check out the links in the description because you can get up to $50 when you sign up to purchase investments like stocks or cryptocurrency. So check that out. But let's get into this, and I want to show you this article first that says that 35% of Canadians think that this change could lead to bankruptcy. So here's the headline. As a result of these rising interest rates, people think that this could push them into bankruptcy. And we'll get into exactly why rates are rising and what this means for you. But first, we need to talk about the cause and the reason that interest rates need to rise now or else. And it all stems from this, Canada's rising inflation rates. Now you can see here that Canada's all the way up at 5.1%, and that's higher than it has been leading all the way back into the early 1990s. So this is a record high rate, and there's a problem here because, of course, with higher inflation, there's a higher cost of living. People can't afford to keep up, but there's also something else that could potentially happen if we see these inflation rates stay incredibly high. If we see these rates high, as well as people expecting these rates to stay high, we can enter something that's called an inflationary spiral. When we see these rising prices, it starts at the top and works its way down and then ends up looping back up to the top in a cycle. Let me explain exactly how this works. When we see businesses that have higher expenses, well, the only way for them to offset those higher expenses is to raise prices. When businesses charge higher prices, of course, people need to pay more in order to buy the things they were previously buying. But where do these people get their money? Well, it's from working, right? So they often have to go to their employer and say, hey, well, rising cost of living, rising prices, I need a higher wage now in order to purchase the same things that I was previously purchasing when I was working here. But if businesses need to pay workers more in order for them to keep working there, well, then that raises their expenses and they have to charge more in order to pay for those expenses to remain profitable. And when they raise those prices, people have to pay more, people have to ask for a higher wage, and you can see how this inflationary spiral starts to get going, and this is exactly what the Bank of Canada is trying to avoid right now with their interest rate hike. Here we can see the Bank of Canada's interest rate rise, and it's the first rise right here, this little blip at the bottom right of the chart. That is the first rise that they've made to interest rates since the beginning of the pandemic. Now, you'll notice right here, this point in time is the beginning of the pandemic, and interest rates absolutely went down to the bottom. Now, the Bank of Canada, through a number of sort of tools that they have, lowered interest rates dramatically in order to stimulate more spending in the economy and also to prop up the government's ability to support all of these pandemic spending programs. But a low interest rate often leads to more inflation because when you have lower interest, people spend more and people borrow more and they use that money to buy things, raising prices. This contributes to the inflation issue. But now, because inflation is at the record high that we're seeing it at, well, the Bank of Canada is saying, okay, maybe now in order to try to get inflation under control, we can raise interest rates. Okay, sounds pretty good. But unfortunately, raising interest rates isn't a purely good thing when it comes to just lowering inflation. There's also a lot of side effects that they have to consider at the very same time, and it has people pretty concerned. First off, when you raise interest rates, it often leads to a marginally higher amount of people that are unemployed in the country. And this is the reason that this happens. When you have a higher interest rate, businesses tend to be able to borrow less because it's more expensive for them to pay interest on the money that they're borrowing in order to expand their operations, grow their businesses, and provide more jobs to Canadians. Now, for the very same reason as this lowering in employment, this is also a lowering in economic growth in general in the country because of the same reason that you can't expand as quickly when you have to pay more for money, which is what this interest rate is really, right? If you have to have a higher interest rate, it's more expensive to make the payments on the money that you're borrowing. And this more expensive borrowing doesn't just apply to businesses and individuals, well, it also applies to the Canadian government. Now, this is especially an issue right now because over the past 2 years, the Canadian government has taken on record levels of debt in order to fund the programs that they've been rolling out to support many Canadians through the pandemic, through the different measures that they've implemented. Now, if you're somebody who is hoping for more generous support from the Canadian government moving forward, no matter your situation, well, a raising interest rate environment makes that less likely because certainly the government of Canada will have to pay more on their debt with rising interest rates, and many of the opposition parties of the government are pressing into them very hard right now, saying, hey, you're not getting your spending under control, and if we have rising interest rates, well, this is not a good financial picture for the Canadian government. You're not going to be able to borrow as cheap, so where are you going to get the money to pay for these programs? And the other thing that an interest rate rise could dramatically affect is real estate in Canada. Now, depending on the lens you're looking at it through, this could either be a good thing for you or a bad thing. Often when we see an interest rate rise, we see a lowering in the price of real estate because, again, in order to purchase real estate, you need to borrow money. And at a higher interest rate, it's more expensive to borrow that money, meaning people can afford to borrow less and they don't have as much money to put towards their home as a result. But will this rising interest rate actually slow down the blazing hot Canadian real estate market that we're currently experiencing and seem to have been experiencing for quite some time? Well, we can look back at the last time the Bank of Canada went through this interest rate rising period with this chart right here. You can see the green dots. Those are each of the instances where the Bank of Canada rose its rate by about 0.25%, the same rate rise that we've just seen. These orange dots are representing policy changes, so some sort of major government change, whether it be provincial or federal, that could have an effect on the housing market. And what we can see here, interestingly, is that the interest rate changes, at least in this most recent time that we saw it raising interest rates, well, it didn't do a ton in order to quell demand for real estate. Instead, it was this policy change here that we see back in 2017 that resulted in a lowering of real estate prices by roughly $100,000 on average. So it's difficult to be certain on whether or not this will actually dampen demand for real estate and result in lowering prices, or if it'll just be an evening out, or if we'll continue along the pace that we've been going. It's challenging to tell, but there also is an additional human element of this. Over the past couple of years, and actually over the past decade, we've seen rather low interest rates, and people have gotten accustomed to having low for long interest rates. Now, what this resulted in is more and more people being comfortable in taking on high amounts of debt to purchase real estate, expecting that these interest rates were going to remain low for a long time. Now, the Bank of Canada here raising interest rates is also raising the rates that people are paying on their mortgages, and as a result, people will have to pay more each month on these mortgages. Now, hopefully the Bank of Canada will do this slowly, because I think that there's a lot of people who may not know better that have sort of locked themselves into these high amounts of debt to purchase this real estate, feeling like, hey, the real estate market's going to get away from me if I don't do this now. And if they see this rising interest rate change, well, a gradual one might be easier to stomach than a larger rate rise. But there is a chance that the Bank of Canada could boost this rate rise even farther than it is right now. There's a chance that we could see inflation spike even higher. Remember, inflation is the thing that's mainly causing the Bank of Canada to raise these interest rates, and this could be a result of what's happening in Ukraine. Now, obviously, as a disclaimer, the situation in the Ukraine is absolutely awful, and the most important thing is the human element that's going on there and the lives that are lost. Obviously, that's awful, but I'm here to comment more on what's happening with these financial markets. That's my expertise, my area. Along with these governments. But this situation in the Ukraine could lead to higher inflation or a spike of inflation because with these sanctions on things like oil, we could see less supply of that oil and the same amount of demand, leading to even higher prices for many different things that we were previously receiving that are now sanctioned. So we could, in the short term, see an even higher spike of inflation, and that could lead to the Bank of Canada raising rates even more quickly, meaning all of these sort of negative negative things that I just listed about raising interest rates could happen even more so. So it's going to be interesting to see what the Bank of Canada does moving forward. It's definitely going to be more uncertain now with everything that's happening in the world than it was just a month ago. But let's take a look at what this could mean for different investments. We've talked about real estate already and how uncertain that is, but now let's take a closer look at stocks and crypto. Now, in general, higher interest rates often lead to people moving away from riskier assets, moving from something that's riskier like a growth stock or crypto into something that's a little bit more stable like some blue chip large company stocks or even government bonds. Okay, so why does this happen? Well, when you're investing, you generally have to measure risk and return. Sometimes people will go farther along the risk curve and expecting a larger return than someone who is not as far down the risk curve or the volatility curve. So if you're in an instance where there's rising interest rates and with something like a bond, you're able to get a higher return, well then maybe the calculation for you on risk versus return changes and you don't really need to go into those higher risk assets, and instead you can put some money into lower risk assets that are going to generate you at least a decent return with these higher interest rates that you're able to achieve. And higher interest rates also aren't that great for growth stocks in general for some of the reasons that I mentioned earlier. When you have a higher interest rate, it's more expensive to borrow money, and most growth companies will borrow money in order to expand their operations and produce higher revenues. So let's take a look at an example growth stock here, one of the ones that's grown significantly over the pandemic, and that is Tesla. And by the way, we're here on Wealthsimple. You can use the link in the description to open up an account, and you can get $50 for free when you open up a new account with Wealthsimple. But you can see here with this Tesla stock, and looking at the chart here, that since we've entered this interest rate environment where we're expecting higher interest rates, well, we've seen a general downtrend over time compared to when you look at 1 year with this dramatic increase with the sort of loose money policies and the low interest rates that we had during the pandemic. But now switching gears and taking a look at crypto. Well, in general, crypto tends to trade along with the macro environment based off of news and concerns in the world. We can see this here recently as tensions were rising. We're looking at the Bitcoin chart here on Newton. Again, link in the description. You can take a look for yourself. You can see there's a drop here in price as we had fears of this impending invasion of Ukraine by Russia. But the other sort of side of the story here is that crypto, while it does trade correlated to the macro environment, also it can trade largely based on narratives or the sort of stories that are associated with those assets themselves. We're seeing a slight rise in price here, both in Bitcoin and Ethereum, two of my largest crypto holdings. And I think that this is largely due to the narrative that's coming out of the Ukraine about how crypto assets may have actually been beneficial for this situation, and emphasizing the need for a decentralized monetary system where users can leave with their assets when they need to if there's an emergency, along with how easy it's been for people to use crypto assets to donate to Ukraine in order to help with this. It may be more difficult to do through a bank or through traditional means. So while we are seeing this sort of uncertainty in global markets, well, there's also sort of use cases that are being demonstrated here for these digital assets. But if you've watched the channel, you'll know that generally I like to do a bunch of research and find assets that I personally believe in long term and invest in them and buy and hold those for the long term. I'm not much a person who likes to trade these assets. Instead, I'll find something, again, buy it and hold it. Time in the market, the amount of time that you've been in the market, is far better than trying to time the market and buy at the perfect time. That's just the way that I like to look at things. And also I'm more invested in these sort of higher volatility, higher risk assets, largely because I am more comfortable along the risk curve being a little bit more risky for a couple of different reasons. One of which is being so young as I am, I can take these sort of risks and know that I have time to recover if there is a large correction in the digital asset market. When it comes to whether or not these interest rate changes will actually have the impact that 35% of Canadians believe it will, bankruptcy leading from these interest rate rises, I think that is a little bit overblown, certainly in terms of mortgage rate increases. For most mortgages, these just sort of quarter point or like 0.25% increases in their mortgage rate if they're on a variable rate mortgage won't result in too much higher higher of a payment that they're going to have to make. So I ultimately don't see that having as big of an impact. And I think if they explained this to the people who were taking this survey, maybe they would know that that is the case, and maybe it wouldn't actually lead to financial ruin as a result of these changes. But in any respect, we can take what's happening right now and learn it and apply it and sort of have a better understanding of what's going on in order to set ourselves up and our families up for a better future, at least have a better idea of what could come in the future. But that's it for today's video. I'm curious what you think about all of this. Obviously, there's a lot to talk about here, so let me know down in the comments. I read every single one and try to get back to as many as I possibly can. And with that said, thanks so much for watching, everybody. I really hope this video has helped you out at least a little bit, and I'll see you next time.